Hi, this is Tomomi, Las Vegas Realtor here. And today I have a loan officer, Lisa-san, with me. Hi.
Hi.
So when we want to finance to buy a house, we can choose either fixed rate or adjustable rate, right?
Yes.
So what is fixed rate?
So everybody's very familiar with a 30-year fixed mortgage. So this means your rate never changes for the life of the loan for 30 years. And adjustable rates, it's called ARM, and an adjustable rate has two phases, meaning first phase, it's fixed, and the second phase, it adjusts.
So ARM has two numbers, right?
Correct.
So you will see
You've
like
seen it
ARM
before.
number 5 or 2 or something like that, right?
Right.
So I want to know what does it mean.
Right. So the first number presents how many years the interest rate is fixed.
Okay.
And the second number presents how often the rate adjusts after that.
Could you explain with example?
Sure.
So I see 7/6 ARM.
Yes.
What does it mean?
Right. So a 7/6 ARM means the interest rate is fixed for 7 years. It never changes, just like a regular fixed rate. And then after that phase, your interest rate adjusts every 6 months.
Okay. Then how about 5/1 ARM?
So for example, fixed rate for 5 years, and then it adjusts annually because it's just one.
So what's good about this ARM product?
So you never heard adjustable rate ARMs when the rate is low. If the rate is low, might as well just fix it for 30 years.
Mm-hmm.
But adjustable ARMs comes in really handy and a very useful tool. If you know the market's going to shift going lower later on, you have 5 or 7 years fixed. During that time, if you want to sell or move or refi, you have a chance to do that during the fixed period of time. And then after that, if the rate goes down or high, you're fixed. You have no risk. And then with that loan, introductory rates are pretty lower than the regular 30-year fix. So you have a lot of saving upfront.
So ARM is typically much lower rate for the first certain period of time.
That is correct. Compared to a regular 30-year fixed mortgages, because, there's introductory lower mortgages and then you just take advantage of it.
So if somebody is planning to sell within a couple of years or within a couple of years, they want to refinance, this is a great product.
That is correct.
But if somebody want to keep it for like 30 years, there is a risk, right?
There's a risk. And this is good for a short-term plan. And if you know for sure in the next 5 to 7 years, you're going to be moving or selling or refi, this is the way to go. Or if you're expecting income growth in the next a couple of years, that's a way to go. Because for the first few years, you can save on your monthly mortgages payments.
Mm-hmm.
So depending on your life plan, this could be a really great tool. A lot of people are scared of it because they don't know. People get scared if you don't know what it is. But if you know what it is, how to use it, it's a great tool.
I see. But typically, we suggest go with fixed rate, right?
It's because a lot of people prefer
monthly up and down.
Right.
Mm-hmm.
They want to know predictable payments, instead of like, okay, what is going to be? But like I said, adjustable ARMs, you don't have to worry about that for the first phase. It's all fixed during the first 7, 5, or even 3 or 10 years even, depending on the lender, what they have.
I see. So I heard there is a cap. So after a certain period of time, let's say 5 years, interest rate is going to change, but there is a cap.
Right.
Right.
So for example, there's a 225 cap. What it means is first adjustment cap. All right. The maximum is 2% plus increase. Let's say, after 5-year fixed period ends, and then if the market wants 8%, for example, no. You're locked in with a 2% increase only. So you're going to go up only 7%, not 8. So you're going to be protected by the cap.
So in that scenario, if you have a 5% rate now, then after the adjustable rate period ends, it will be 7% at most.
Right.
And otherwise, we don't know what the market rate is.
Right. That's adjustable cap, max 2%. And then annual cap, there's also annual cap. It's 2% per year. So same thing, two protected at only 2% increase. It never goes above what it is. And then at the end, there's a lifetime cap, meaning there's a maximum, absolutely maximum 5% cap, even though the market wants 10%, for example, or 11%. You're locked in 10%. So you're protected for lifetime.
So you will get the lower rate right now, and there is a max that interest rate can be in the future.
In case you decide to keep your loan, which I wouldn't recommend if you're going to do your ARMs, your plan would be within the first 3, 5, 7 years, you're going to refi or sell it or move it. That's the game, name of the game, right? If not, you're not really, taking advantage of it.
So it's really depending on your life plan.
That is so correct. So that's why you need to talk to the lender who understands and ask you questions. Okay, what is your life plan for the next 3, 5, 7 years? That's very, very important. Not every loan creates equal. So.
Okay, thank you so much. So if you have any question with loan products, please contact her and she can be a great source of help.
Yes, and I'll also have a full length of a YouTube video about adjustable ARM rate. So if you want to check it out, there's a link to it. Well, we'll see you in the next video. Bye!